If you had $400,000 right now, and someone told you to put it into either the stock market or a rental property, most finance channels will give you a confident answer in the first 30 seconds. I'm not going to do that. Instead, I ran the actual math, every hidden cost, every tax rule, every number nobody puts in the thumbnail, and the result surprised me. Stick around, because by the end of this video, you'll know exactly which one wins for you, not for some generic average investor. This is quiet wealth. Let's get into it. Here's the problem with almost every index funds vs real estate video you've ever watched. They compare a clean 10% stock market return to a real estate deal where they conveniently forget to mention closing costs, or they compare rental income without ever mentioning a vacancy month, a broken water heater, or the property tax bill that shows up every single year whether you like it or not. That's not honest math. That's a sales pitch dressed up as education. So today we're doing this differently. We're going to build both scenarios from scratch, include every cost that actually shows up in real life, and let the numbers speak for themselves. Let's start with real estate, because this is the one people usually get wrong, in both directions. Say you buy a $400,000 rental property. You put 20% down, that's $80,000, and finance the remaining $320,000. Here's what most people forget to add up: mortgage interest. Over the life of the loan, you'll pay tens of thousands in interest, especially in the early years when almost none of your payment touches the principal, property tax and insurance, typically 1 to 2% of the property's value, every single year. Forever maintenance and repairs. The standard rule of thumb is 1 to 2% of the property value annually. Roofs, vac systems, and plumbing don't ask permission before breaking vacancy. Even great landlords deal with empty months between tenants. Budget for it. Property management, if you're not managing it yourself, that's another 8 to 10% of rental income gone. Now here's the part real estate fans love to talk about: leverage. You only put down $80,000, but you control a $400,000 asset. If that property appreciates 5% in a year, that's $20,000 in gains on an $80,000 investment. That's a 25% return on your actual cash before you've even collected $1 of rent. This is the double-edged sword of real estate. Leverage magnifies your gains, and it magnifies your losses just as fast. And one more cost people ignore: illiquidity. If you need $10,000 next month, you can't sell 2% of your house. Your money is locked up until you sell the whole thing or take on more debt through a refinance. Now let's put that same $400,000 into a low-cost S&P 500 index fund. No down payment needed. The full $400,000 goes to work immediately. Historically, the S&P 500 has returned close to 10% annually before inflation, though your real, inflation-adjusted return is closer to 6 to 7%. Here's what you're not paying for: no mortgage interest, no property tax, no maintenance calls at 11 p.m., no vacancy risk, no property management fees. You are paying a fund expense ratio, but on a low-cost index fund, that's often under 0.1% a year. Almost nothing. The trade-off? No leverage, unless you're using margin, which most investors shouldn't touch. Your $400,000 grows as $400,000, not as a leveraged $2 million asset like the property could represent with financing. But you get something real estate can't offer: total liquidity. Need cash next month? Sell some shares. No agent, no closing costs, no 6-month wait. And tax-wise, long-term capital gains on index funds are taxed favorably, though real estate has its own tax advantages too, like depreciation and 1031 exchanges, which let investors defer taxes by rolling gains into a new property. So let's put it all together over a 20-year hold, same $400,000 starting point, using realistic, not best case, numbers for both when you net out every cost on the real estate side and compare it to the net after cost growth of the index fund side, the gap is a lot smaller than either team wants to admit. Real estate can outperform, but almost entirely because of leverage, not because real estate itself is a magically better asset. Take the leverage away, and index funds often win on a pure return basis. So which one is actually right for you? If you're comfortable with debt and hands-on problem solving and you want to use leverage to accelerate your net worth, real estate can be a powerful tool. If you want simplicity, liquidity, and a truly passive way to build wealth without ever fixing a toilet, index funds do the job with far less stress. And here's the quiet wealth truth underneath all of it: the best investment is the one you'll actually stick with for 20 years. The boring, honest math almost always beats the exciting story, because the exciting story is usually missing a few numbers. If this kind of honest, no-hype breakdown is what you're here for, subscribe to Quiet Wealth, because next week, we're breaking down the recession indicator that's never been wrong and why it's flashing right now. See you in the next one.